What's up guys, my name is Nigel and welcome to my channel Investment Rants. Now in my previous video I said that I perform an equity valuation on Transocean and get it done by Wednesday, but somehow it takes longer than I thought it would, so I got it done finally. Today is Friday, sorry. And here is the equity valuation and report of Transocean. Now let me start off first with the industry and what this company does. So this company and its subsidiaries basically focus on contracting their services in drilling oil and natural gas wells to with their drilling rigs, equipments, and crew for energy companies. Now this is definitely not a unique service. Other companies definitely do this. One company that comes up to my mind right off the top of my head is Diamond Offshore. But so this company is headquartered in New Zealand and trades under the stock ticker RIG in the New York Stock Exchange. It sells its services globally. And its major customers that occupies like 10 to 12% of its customers. It's like Shell and BP, which is like their big customers. It also has joint ventures in other parts of the world, such as Cayman Islands, Virgin Islands, Malaysia, Indonesia, and it's pretty global operation. So right now, the stock ticker is trading around $16-ish plus, around that price right now, and I think definitely this stock is undervalued, and I'll explain why I think it is. But first of all, let me go on to its competitive environment. So it is a cyclical industry. It depends a lot on the natural gas and oil prices, and of course, if this is going to be cheap, companies are not going to be finding it easy to get into the oil and gas industry market, as right now oil and gas prices is rather low, $60 per barrel, around there. So we should be expecting a drop in sales revenue. This industry is competitive, with none of the participants having a dominant market share, so contracts are awarded on a competitive bid basis, and the deciding factor would be the price, but also to a lesser extent probably be the availability of rigs and the skill of the labor force, that sort of stuff. Legal and regulatory issue wise, this company does face some issues, especially in one of the recent incidents in 2013, which was the Macondo well incident, and the company so far has been sued around $410 million with this issue. So going forward, I think this company might face some difficulty in circumventing or like navigating the legal and regulatory environment needed for a company that deals with natural gas and oil. But we should not see probably a barrier which is going to like significantly disrupt the business. Now, management-wise, I think that this company's management team is pretty experienced. They know what they're doing. I didn't really research much on each executive, but from what I can tell, what they are doing is operationally, we're looking at money being invested in R&D. So they're investing money in R&D, basically coming up with new world technology, like improving the efficiency of their drilling ships, and all that sort of stuff. Dividends are started being issued on 2011, which signals confidence for the company from the company's standpoint, as well as not too many acquisitions are being made. In fact, they actually sold some of their subsidiaries. But if a company does a lot of acquisitions, it's going to mean that the company is going to be paying unnecessary premiums. Most of the time, they're going to be paying unnecessary premiums. They're going to be earning a return on invested capital lower than their weighted average cost of capital. So a company that does very low acquisitions is going to be more focused towards organic growth. So they know the concept of creating value. So they know what they're doing. Money that they spend are being reinvested back into their business by purchasing more equipment and rigs. So that is good, as they have confidence in their business. Now we're looking at the spreadsheet, the financial. Let's start off first with the financial ratios. Profitability ratios are pretty good actually. And I'm looking at the after-tax operating margin to be around 30% on average. So they're earning quite a good operating margin. And also, I'm comparing their return on invested capital, the ROICs. Actually, they're earning consistently higher than their weighted average cost of capital, which in essence creates value and therefore wealth for the company. However, what bothers me about this company is its debt levels. The company's long-term debt is around $10 billion in 2012 and 2013. That's like its long-term debt. So should oil prices remain low for extended period of time, it could spell trouble for this company. But on the bright side though, this company's short-term solvency is pretty good with this current and quick ratio above 1. So in the short term, this company should be able to weather the drop in oil prices for some time before it hits the red zone. So drivers for this business, the main drivers for this business is the sales, cost of goods sold, and its property, plant, and equipment. And surprisingly, what's surprising is the SG&A expenses, sales, general, and administrative expenses is rather small. Now for sales, I'm looking at the adjusted sales growth last year. In 2013, we saw a sales growth of 3.1%. The previous 2012 was very low. It's like 0.06%, 0.6% actually. But long-term sales growth, I am projecting long-term sales growth to be around 4%, given the cyclical nature of the business. So 4% is a reasonable, more conservative estimate, but I think it's reasonable. Basing it off on the nominal GDP growth, as well as giving some leeway, some room in expanding the business. So 4%, I think it's rather reasonable. Cost of goods sold is around 65% on average, so it's really doing well in these figures, and I believe that it could go down further because due to the R&D, so the company is doing lots and lots of R&D, so that could improve the cost of goods sold. This industry is highly capital intensive, but I estimated the net property, plant, and equipment to be a function of sales, and I kept it constant around 2.3 times the sales amount, which shows an increasing trend. From last year, they are purchasing more equipment. From last year, they are actually buying new jackups and constructing new drill ships and submersibles. So in conclusion, I estimated the intrinsic value of this stock to be around $50.81, way above its. In fact, this price, $50.81, was traded on like June 2014 June last year. It was around $55. So this stock price is reasonable. And right now it's $16, and I believe it's because of the depressed oil prices. And oil prices it's not going to stay low forever. So we should see a rebound in the stock price if the company manages to survive the depressed oil price, and we should see the company going back to its intrinsic value in probably like a couple of months or a year. But I think I recommend this company to be a buy. So once again, thank you for watching my video, and as always, feel free to comment on anything I could improve on my video, as well as comment on any other companies that you want me to evaluate. And I'll see you guys a couple of days time with a new company. Thank you.